Well, hello and welcome back to Jones Financial Talk. This is Nick Jones with Jones and Associates Premier Financial Solutions. Listeners, if you'd like more information about what you hear on this fine show that we do every weekend, you can get that information in a couple of different ways. You can just go to our website at jonesfinancialtalk.com. On the website, we have a radio page dedicated there to Mr. Tony Shore, my co-host, and I. Every single week, we have a new topic, and it is available on that radio page. You can also subscribe to this program on all kinds of different mediums. Spotify, for instance. You can download and listen to some of the previous shows if you'd like. And if you'd like just to get more information about what you might hear today on the show, you can always just give us a call at 541-500-4321. Now, listeners, today I have an interesting topic. I was discussing this with many clients in the last couple of weeks, actually, and this specific topic is about gifting strategies. And as you probably would think, there are significant tax benefits with gifting strategies if they're done correctly. And so I want to go into some of those details a little bit more today with my co-host, Mr. Tony Shore, who always gives us a gift when he comes to this show, folks, doesn't he? So, Mr. Shore, how are you doing today?
I don't know if that was a joke or that's honest. That's nice. The crowd, please. I'm just a man. All right.
Thank you again, Tony.
Great to be here, Nick. It sounds like an interesting topic. I'm interested in this because my wife and I have been setting up our legacy plan, meeting with the estate planning attorney, and of course, a financial advisor. This is where you always help out and help your clients as well. You want somebody looking at the big picture, but I'm excited. I've been doing great. In fact, I got out. It's been nice. So I got a lot of yard work done recently. I finally got to the point where I could get out there and get some work done. How about you? What have you been up to, Nick?
I think here in Southern Oregon, we officially are out of winter. We've kind of been teased a couple of different times, but we're going into 80s. So I'm looking forward to it. Just got done with tax season and tax planning and on to the next tax planning topic. I mean, there are things that we can discuss and that we do discuss with our clients year round. One of those I'm interested to talk with you more about today, gifting strategies. I think this is going to be a good show, Tony.
Well, yeah, we all want to minimize that tax burden, not only for ourselves, but you don't want to leave your loved ones with a tax burden either. And so some people who have built up some money and want to pass it along, there are good ways and bad ways to do that. Or maybe the thing is gift it while you're still alive and want to see them enjoy it. You want to enjoy your money while you're doing well and living, and you want to see your kids or grandkids enjoy it. So there are a lot of IRS rules around gifting. So I'm glad we're going to tackle this topic. It's a big one, and it can make a huge financial difference, whether for you or for your loved ones. Is that correct?
That's exactly correct. And with anything, if you do the proper planning before something happens, you're going to obviously get the best benefit. And part of that is just having the conversation with your financial advisor so they understand what you're trying to do. And, there are a couple of very basic questions that I think everybody should ask themselves. And, the main one that we have kind of tied in with multiple shows this year is, have you thought about the legacy that you'd like to leave? And if you plan now, you're going to be able to help ensure that your estate goals are met when that time comes. And there's just a lot of important issues that you need to consider when you're thinking about estate planning and gifting in general. The most basic, who, what, and how. And what does that mean? Well, who do you want to benefit from your estate? And what goals are and do you have for distributing your assets? And then finally, maybe how do you minimize the impact of taxes when we think about how drastically taxes are going to be a difficult thing for your estate? Tony, we've talked about this before on the show, and I think many of our listeners know this, but there are maybe a dozen states in the country that have estate tax, death taxes. And Oregon, unfortunately, is almost at the lowest threshold. Estate taxes start at $1 million of total assets in the state of Oregon. And I know Minnesota, where you're from, also has a very low threshold. But the point is,
it does.
Most people that we're working with have assets over $1 million. And one of the biggest things that they always ask me about is how do they reduce their tax burden? And tax burden is a couple of different things. It's one, while you're alive, but it's also two, when you pass away. And there's just a huge mess that can be left if you don't organize this correctly. So we've got to talk about it, Tony.
Yeah. Yeah, and I think that's hugely important. And you're right. You don't want to leave a tax burden for your loved ones. And when my grandfather passed away, my dad inherited a portion, and then his three siblings as well. But it gets messy. And I see the mistakes that can be made, and they can be costly from a tax standpoint. I mean, very costly. And people think, oh, millions of dollars, I'm not that wealthy. But you know what? My mom and dad had hardly any money. They were blue collar people and didn't have a ton saved. But the farm, was hundreds of acres.
Sure.
And so when he passed away, the equipment, the farm, the home, and the buildings, it all added up. I mean,
Definitely.
There were four siblings to inherit, but the total value of it was about $4.2 million.
Yep.
And that's well over the Minnesota, threshold. So it needed to be set up in a way that you wouldn't have to sell the farm to pay the taxes.
Yep.
And so it wasn't. We had to go in and make some changes, and the first CPA and estate plan, an attorney, not an estate planning attorney, who looked at it said, "Yep, collectively total, there's about $224,000 of taxes that need to be paid here. It'll have to be divided
with no liquid money to really help figure that out."
And there's no liquid. There's nothing that was liquid.
Yeah.
Okay. I mean, I think there was like a total of 65,000 in CDs or something, but that's not going to help so much. And so I said, no, there are rules. With the farm had been in the family, and my dad was still living on the farm and farming the farm. And so, and his land anyway was attached to where the house was. So we found out that there were ways to get around that, so you wouldn't have to sell the farm and pay these taxes. But they just told him, they just sent him said, we filled out the form. Minnesota says you owe this much.
Yeah.
And I said, wait, hold on.
Right? Let's review this with somebody else.
Yeah. Yeah.
Well, and the interesting thing, Tony, is from a tax planning standpoint, lots of things came into IRS tax code because of farms in the Midwest. Yeah. And one of the biggest things that could be on the chopping block, depending on who gets into office this fall, is definitely related to what's called the step up in basis. And the reason why this step up in basis was so important initially was to preserve these family farms. Just like in your situation, blue collar folks, work hard every single day to provide agriculture for the country. And when their parents pass away, they get stuck with a $200,000 or $300,000 tax bill that they can't even afford. So what happens? They got to sell the farm, right? And then what happens to the farm? Maybe it doesn't continue as a farm, and so we start losing our resources. That's why there was the original step up in basis in the tax code. And that brings me to a very good point, Tony. The reason why this is such a hot topic, or should be something that you're discussing with your accountant and your advisor, is because whoever gets into office is going to have a huge role in what's going to happen with taxation going forward, right? There were lots of things that were
all the current tax laws, a lot of them, the big ones, expire.
They expire next year, right?
Yeah.
And even like people may know what the Tax Cuts and Job Act is, and that governs lots of these kind of sunsetting taxation benefits today. And depending on what we're talking about and what taxes are due, they're sunsetting sometime at the end of this year or between the end of this year and the end of 2025. Right. And so the reason why that's important is this is the year, maybe the last year, to do adequate tax planning from a gifting strategy standpoint, from a conversion with Roth IRAs, possibly. If you have large capital gains built into a piece of property and you're thinking about, selling that piece of property, we don't even know what tax rates are going to be next year. Why would you go into that scenario without doing some planning to see if maybe now is the time to stay at the current rates that we're at? That's the
Yeah.
whole point.
Because at least federal income taxes are at historic lows right now. It's basically taxes are on sale, but there are so many rules and regulations. You don't want to go on your own. And I know that at Jones and Associates, you work alongside estate planning attorneys to help your clients with these types of things, correct?
Definitely. And, there's lots of main documents that you need in an estate plan. We've talked about that before, but, different types of trusts can be very beneficial. But probably the most basic thing to start with on our show today is, just gifting strategy in general.
Okay.
And, federal gift limits are very, very high. They go up every single year. Currently, they're about 13.5 million, meaning you can give that much money away in your lifetime and have estate tax like exemptions federally. Okay. The annual exclusion for gifts, which is what most clients ask me about this year, is $18,000. And that is per person.
I remember when it was 10.
Yeah, it is indexed every single year and goes up. And, the reason why it's important to know those numbers is, these adjustments that we're talking about to estate taxes, present great opportunities for families that are looking to transfer wealth, especially those who are trying to do it, ahead of the potential reduction in these tax exemptions. And
so by saying that, do you mean, let's say my dad wants to give me, or your father wants to give me, or maybe my wife's mom wants to give her $15,000 to help pay for our kids' college or something, or to help us, maybe put on a new roof or remodel. She can give us that money, and we don't have to pay taxes on it as income.
That's right. And actually, Tony, it's per person. So like if you and your wife clearly are married, then your parents or anybody could give you and your wife a total of $36,000 this year.
Okay.
And that
I didn't realize that it is, if you're a couple, that goes for each person. So it doubles. Yeah. Okay.
That's right. So let's just say that you're a couple with 3 children. And you want to plan gifts for each child, let's say through the child's life. Right. You can do that over a very long period of time and give up to $36,000 to each of your children if they are married. Okay. And that's from each parent also annually. Okay. So that's an important thing to know.
So it's individual to individual. Like if my dad wanted to give me $15,000 and my mom wanted to give me $15,000, they could, or they could even give it to 30 saying this is for you and Sarah.
That's right.
Yeah.
That's right. Okay. And so if you think about being able to give somebody $36,000 a year, and let's just say that they take that money and they invest it and they get a 7% rate of return, that money doubles every 10 years. So if you would just leave it in your account, let's say you're 70 years old. And let's say you're going to live till you're 90. So you got 20 years left to give money away, basically, is what I'm trying to say. If you just gave $36,000 one time to one of your sons that's married, okay, that $36,000 is going to double. So it's going to turn into $72,000 in 10 years. And in 20 years, it's going to turn into what? $144,000. Okay. Now, if you just left that money in your own estate and then tried to give it to them at death, yeah, they'd get it, but it wouldn't be tax-free necessarily, right? So just by giving them one $36,000 installment one time over a 20-year period at 7% return, you're in essence giving them $144,000 if they're going to invest that money.
Yeah. Wow.
That's a huge amount. And think about if you did that annually, right? Think about if you did that annually. The other thing that's interesting about tax law today, and that definitely should be highlighted on our show, is the IRS actually allows you to give a gift to somebody and accelerate it up to 5 years. Meaning I could give you $18,000 today, but I could also just give you 5 years of $18,000 in installments right now. So 5 times 18 is what? That's $90,000. So this year I could give you $90,000 all up front because it's my gift to you over the next 5 years. Now I can't give you a gift in the next 5 years until the 90 is used up. But the point is that's a good way to get things out of your estate very quickly. Because then what happens? The 90 in 10 years turns into 180, and the 180 in another 10 years turns into 360. And that was from
Right.
one gift. Now, there's other things that are built into that are very, very important that we need to discuss, like why you're giving the money away and what that actually means, right? And because you do not have control over that money once you give it away.
Right.
And so, you know, this happens a lot with
You notice I used as an example, Nick, my parents giving me money. I didn't use me giving my kids money.
I know, I heard
Did you
that.
notice that distinction?
Did you hear me when I gave the example of me giving you money? But I haven't heard anything about you saying you're going to give me any back. So
No,
this
no,
is
and
the
you
problem.
and
This
you
is gifting, Tony. It's gifting. It's good for your heart.
well, I want to make you feel good. So if you could give me money, I know that makes you feel good. So
One of the things I just wanted to mention that is important is I've got lots of clients that say, hey, look, I'm going to give my kids this much money and I'm trying to remove it from my estate. And that is a great tax planning tool. I'm going to let the kids have the house because it's smarter. The legal aspect that you need to be aware of and the liability that you're getting into could really outweigh the benefit. What I mean by that is, let's say you have 3 children, again, like I mentioned, and all 3 are married, and you're slowly giving your house to all of them, or a large amount of sums of money to all of them. Well, what happens if you need that money later in life? I mean, a lot of people say, well, my kids will just give it back to me. Totally fair. Hopefully they will. But what if they get a divorce? How difficult is it going to be for their spouse?
And in some states,
in
some states, it's if they get a divorce, it's automatically half as their spouse's. Do you want half of that money to go to their ex-spouse? You don't. Do you?
You don't. And that's why it's so important to make sure that you are doing this the correct way. You should be having joint calls with your accountant, your attorney, and your financial advisor to make sure everybody's asking the right questions, and make sure that you don't get into a situation where coming up with a great idea of gifting some money and removing it from your estate is such a smart play tax-wise. But if you don't think about all the consequences that could come into play, you could have issues.
Yeah. Yeah, for sure. And so when it comes to gifting, obviously it all centers around the tax codes, the tax laws, the liabilities. And you've mentioned federal. I find where it gets really difficult, though. Federal seems rather easy because it's fairly uniform.
That's right.
And you spouted some of those numbers there, which are important. You gave us those. But where I see complications coming in is on a state level. I know my home state of Minnesota, that's the costly part of estate tax and inheritance. So how is Oregon on estate tax? I mean, it's not necessarily the best, is it?
No. Well, I mean, like I mentioned earlier in the show, from a total estate projection number, we are the lowest threshold in the country.
Yeah.
So at $1 million of total assets, you're paying starting at 10% of every dollar above $1 million, and it's as high as 16% the higher you go. So let's say that you don't do any planning and you die with $2 million in your estate. Some people might say, well, who cares? The kids will deal with it. Well, they're going to pay an estate tax of $100,000 on the $1 million that's above the $1 million that you're able to have. And so if you just would have given half of that away over your lifetime, that saves $50,000 in taxes, and it's in your kid's pocket. Right. Yeah. So
if you really want to help your kids and don't want to leave them with a tax burden, what you're saying makes sense. But and some people out there might say, hey, I'd be happy to inherit $2 million and pay $100,000 to get it. However, back to my farm, and it's not just about farms. What if you own a business and your family, that business has been in your family, your dad ran it before you, then you ran it.
That's right.
And now you're going to pass away and you want to leave the business to your 2 kids. Let's say you have a daughter and a son, and you're going to leave the business to them. Right. In the business, let's say it's valued at $10 million or 20 million, 20 million, 50 million, whatever the business is worth. It's been built up as a small family business. It's worth millions of dollars. And then they inherit it. The tax, they would probably have to sell it to pay that tax.
Well, yeah, I think if you have a $10 million business at the high rate in Oregon, you're going to owe somewhere between $1 and $1.5 million. Like, who's got that much cash laying around?
Yeah.
You know, I mean, and
Yeah, unless it's a very wealthy family and they've really saved on top of what they've put in the business. But I know that a lot of independently owned businesses, as you do, they cost a lot of money. It takes a lot of money to keep that business going, and staff and everything else. And they're like, well, we can't keep the business going and pay that amount. Then you're stuck, because then you end up owing $1.2 million or whatever it is in taxes. Where you're going to just come up with that money? That
yeah,
was the problem with the family farm, which had been in. My grandfather was raised on that farm, and he lived there until he was 101. And there's 2 houses on the farm. My dad was raised on that farm, and I was raised on that farm. And that
yep.
farm was homesteaded by the Shore family. So there's never been anyone else that's owned that land in Minnesota, or farmed it or worked it anyway. And they homesteaded the land. The original deed we still have from 1855. So
that's great.
Yeah, I mean, that's crazy, isn't it? But then we almost had to sell the farm to pay the taxes at one point. It was looks like, I mean, because there was no other way to do it. But we found that there are laws that protect farms, and we were able to make it work. And so gifting is important, but I think that what I'm hearing here is it's really important to plan ahead to avoid some of these issues. If you just plan ahead with gifting earlier, right?
Yeah, and there's lots of things that you can do for specific reasons, right? So if you want to gift money to your grandchildren and you think they're going to go to college, you could use a 529 plan as a way to gift money. And why would you do it that way instead of just giving them money in a cash account? Well, if you put it in a 529 plan and they use it for educational purposes, there's no taxation on any of the growth. That's huge, right? Also, there's a huge piece of legislation in the CARES Act 2.0 that now allows people to take leftover 529 plan money and roll that money for that beneficiary into a Roth IRA.
Yes.
Again, keeping that money tax free. So those types of strategies is what your advisor should be talking to you about and bringing to the table. Other things that we definitely discuss with our clients as well: different type of trusts to be able to assist you with these tax issues. So in Oregon, most people have revocable trusts where they can actually change them whenever they need to. But if you want to specifically remove investments or assets out of your state, an effective way to do that is through irrevocable trusts. Okay. And the reason why it's irrevocable is it means that you do not have the ability to benefit from it any longer. And so it gets removed from your estate, hence the word irrevocable. Now, you can use different types of life insurance policies, like irrevocable life insurance trusts, that allow you to help your beneficiaries and move specific investments into those types of trusts. Think of this. Most people that are our clients are going to have over $1 million in assets when they pass away. Let's say they have a house for $500,000. Let's say they have an investment account for $500,000. What if they're forgetting about their life insurance policy that's $1 million? Okay, so federally you don't pay any taxes on that, but in the state of Oregon, what happens? Well, now your estate is valued at $2 million, not $1 million. Okay, so
even a life insurance policy, I didn't think that counted as income
or on the state level for estate taxes, not for income taxes. Okay,
but it does count as a state
in certain estate situations. That's right. And so a lot of people come and we talk to them about irrevocable life insurance trusts, and the reason why is if it's irrevocable and you don't benefit from it, now it's removed from your estate and it's not taxable. That's the key. So a couple of different ideas that we've discussed and talked about here: gifting strategies, putting that money into certain specific types of accounts to help people, like 529 plans, putting money into life insurance trusts, right? Irrevocable life insurance trusts, or also using different life insurance vehicles to help pay for some of those things.
Cash value life insurance policies.
That's right. So there are guaranteed life insurance policies that you can purchase that will last until you are 120 years old if you put the right amount of premium to work. And why is that important? Well, if you are going to project out, I've got this great software that I utilize that projects out what your current asset base is today, and at some nominal growth rate, what it could grow to in the next 20, 30 years when you're still living. And from that, we organize and try to figure out exactly what your tax liability is going to be when you think about estate taxes in Oregon, for instance. And so if you have $2 million today, and we think that you're 70 and you're going to live till you're 90, and we get a 5% growth rate, that amount of money, doubles, okay, in the next 20 years, maybe triples. And so then you're in a situation where you owe $1 million in taxes. Well, if you could buy a life insurance policy that's guaranteed to pay at your death that $1 million of estate taxes for the kids, that's a helpful way to offset the estate tax issue.
I see what you mean. Use the death benefit to pay the taxes.
That's right. That's right.
Okay.
And so there's lots of different ways to look at this and try to reduce taxation as much as possible, depending on your state, depending on your personal situation, depending on what you're trying to accomplish. And the point is, you should just be making sure that you're having these types of conversations with your advisor if you're in one of those scenarios where you're living in a state like Oregon and you're going to have assets that are worth over $1 million that you're passing.
Well, I think that makes perfect sense. And it really is important to look at all the strategies. And I wouldn't want to try to figure this out on my own, or even just talk to the CPA who does my, accounts once a year. They're looking back at last year. You've got to have a financial.
It's too late at that point.
Yeah, you need a specialist, and you need a financial attorney or a financial advisor like yourself and an estate planning attorney. And really working together to figure this out. So I know that this is how you help your clients. And I know we have people out there listening. And if there are people out there listening or watching this right now who have more than $250,000 saved for retirement or in investments, you're offering a no-charge consultation for them to sit down and look at their situation, talk about tax strategies for gifting, talk about their estate plan, talk about their financial investment plans, and their retirement income plan. That you cover all those bases, don't you?
Yeah, we do. And that's in our full financial blueprint that is free of charge if you do qualify for that, for sure. And, if you're not talking to to your advisor about all of those topics in some of your initial meetings, then you're missing some great opportunities, honestly. There's lots of great advisors in our area that can help you, but don't let them just only talk to you about your investments. That's like the last thing that we talk to our clients about. If I can save you 5% a year based on some tax strategy, that's just as good as making 5% more in your investment accounts.
Oh, yeah.
Right.
Yeah.
But what if I could do both? What if I can make you more than what you could make on your own, possibly, and still save you with tax planning topics and other specific ideas that you would want to utilize? That's the idea. You've got to be willing and able to ask the questions, and your advisor should be bringing those different ideas to you every day.
Yeah. So what's how can listeners get a hold of you?
The easiest thing is just to go to our website at jonesfinancialtalk.com, but they could also just pick up the phone if they're here in the Rogue Valley. We're at 541-500-4321 and ask us any questions you might have.
All right. Thank you so much, Nick. Great show today. Listeners and viewers, thanks for tuning in. That does it for today's episode of Jones Financial Talk with our host, Nick Jones. Nick, good to see you.
Good to see you, Tony.